All right, guys. Welcome back to our marathon 2021. Right. If you have not seen session one, then you need to check out session one. Right. That I dealt with a couple topics. I dealt with ledgers and trial balance. I dealt with control accounts. I dealt with suspense accounts. Right. So you need to check that out. That was what I did yesterday. Now for today, what I plan to do today, right? I plan to do income statement, statement of financial position. I also plan to do partnership accounting, and I also plan to do analysis of financial records, right? Or we call it ratio analysis, right? That's what I plan to do today, right? I did say that I will not be able to do all the topics, right? Because, time will not allow it, right? But I will do as much as I can. I do have a surprise topic planned to do with you guys, so stick around, right? And let's get right into it. So on the board, as you can see, we are going to be beginning with income statement, right? Formerly known as trading and profit and loss account. Right. So the income statement, let us look at some of the concepts before we even begin to practice for persons who may be new to income statement. And if you are like totally new to income statement, then you need to check out my video on income statement, right? There is a link posted in the description below. Just check it out. For persons who were not at session one, you may not know, but the questions that I am about to do, right, or that I will be doing in this session, they are posted in the description section. It's a link. You just click on the link and it will take you. You just have to search for the question that I am doing. I have done my best to label the questions better than yesterday, right? So just go there and you can find the questions that I'll be doing. All right, so let's look at some of the concepts. So income statement is used to show or to calculate how profitable a business is. It's a financial statement that is prepared at the end of the accounting period, and that is the reason why it is called a final account, right? The income statement is actually made up of two accounts. It is made up of the trading account, and it is also made up of the profit and loss account, right? Very, very important for you to understand. Hence the name, or the old name, trading and profit and loss account. Now the trading account, it shows the gross profit, so therefore it ends with the gross profit, right? The profit and loss account ends with the net profit. And you may be wondering, what do I mean by gross profit or net profit? Well, the gross profit is the profit that is made before expenses are deducted. So the profit that is made before expenses are deducted, you call it gross profit. And then the net profit, right, is the profit that is left after expenses have been deducted, right? And this really is the one that people are interested in, right? They're interested in to see, if the business is profitable, yes or no. All right. So that is what these are the basic concepts of the income statement. All right. So let's get into practicing. I must say that I really struggle to find any past question on income statement in its entirety. I always tell my students that CXC don't really test income statement outright like that. They will test several principles from income statement, and that is the reason why I believe income statement, understanding income statement is fundamental, because it can be tested in other areas, other topics, manufacturing accounts, company accounts, partnership accounts, right? Ratio analysis, all of these things. If you don't know, or if you don't understand income statement, you will not be able to do. So they can test income statement principles in other subject areas. So I looked out the last decade and I could not find, well, the last decade June exams, and I couldn't find any outright income statement question. So I decided to just do a question from the textbook, right? The textbook does have good questions. For persons who have this textbook, this is the textbook that I'm using, Principles of Accounts for the Caribbean. This is the 6th edition. There is another one, the 5th edition by Frank Wood and Sheila Robinson, just the same. It's the same book, right? And even the 4th edition can be used as well. The same questions are there. So let's get right into it. We're going to be doing exercise 28.10, right? You can just check in the description, click on the link, and it will take you to a folder, right, where I have those papers. So you can just look at question 28.10. That is what I'll be doing now, so you can get a better understanding. I would like for you to follow while I am working out the question. So let me just take this off the board. All right, so let me just draw up this account now using my blue marker here. All right. I'm going to use the blue marker to write. Hope you guys have your pens and your pencils and your papers, you know. Right? This is a practice session. All right. Now the first thing to do when you see a question like this, right? These questions can be very confusing to look at, right? Because they give you a lot of information, especially because we are going to be doing adjustments to the income statement, right? They can give you a lot of information, but you can't be flustered. You have to just pay attention. Read through the question carefully. Start from the top. Read, take your time and read through the question, then you begin. All right. So the question says that the trial balance now shown was extracted from the books of J. Webster as at the 31st of December 2017. Right. We are given the trial balance there. We are given the information that we need to extract or to do the income statement. And then it says that the following are to be taken into account as at the 31st of December 2017. Now these are what we call the adjustments, or I call them the footnotes, right? So we are given A, B, C, D, E, right? So basically we are given 5 adjustments to be made to the income statement while we are doing it, right? And so we have to take them into consideration. All right. So I guess we can begin, right? So we're going to start with the heading. So the heading is what? J. Webster, right? J. Webster, right? So you have J. Webster income statement for the year ending 31st of December 2017. All right. Right. So that's your heading is very important. Ensure to write up a heading. And now we're going to begin. We're going to be doing our trading account, because the trading account is what you normally start with first. So the trading account, you go sales. Right. And before you even write the sales figure, be sure to check if there is any item to adjust the sales. And there's only one item that can adjust the sales figure, right? And that is sales returns, or returns inwards. So you will check now to see, right, if you see any sales returns or if you see any sales returns inwards. So yes, I see it, and therefore it means that the sales figure is to be adjusted. So you would put the information in this column here, the middle column, right? When we are doing adjustments to final accounts, adjustments to the income statement, we normally use three columns, right? Because the purchases figure, this column basically or primarily is to adjust the purchases figure, right? If we are doing major adjustments, right? So we're going to put the sales figure here. So these two columns are the adjustment columns. This column is the totals column, right? So the sales figure is 91,400. Right, you're going to less sales returns. I like to use the new names, right, because that's what CXC is going to be testing. So sales returns, right? 1,200. Right, so you have to check now. Get your calculators out. By now, all of you should have your calculators. Right, you should have your calculators. Ensure that you practice with your calculators. Very important, because if you don't practice with the calculators, then you're going to have challenges in the exam. Right, so you get the calculators out and you calculate that, subtract it, you get 90,200. Right. Alright, now this is what we call the net sales. I could have put the net sales here and write net sales, but for space reasons, I'm not doing that. You can do it like this as well. So we move on to another heading, less cost of sales. Some people say cost of goods sold is the same thing, cost of sales. You normally start with your opening stock, right? So what is our opening stock now? Or you say opening inventory. Our opening inventory, right, is 31,630. Always put it in the middle column, right? Tell my students that the opening stock always go in the middle column. Then we add purchases. Now, even before you write the purchases figure, you have to check if the purchases amount is to be adjusted. And I see you have two items that you can adjust your purchases figure. You have purchases returns, or you can say returns outwards, or carriage inwards. These are the two items that can adjust the purchases figure. When you're doing your income statement, ensure to check if you see these items, right? Be sure to check if you see these items, because if you see these items, then you know that the purchases figure have to be adjusted, and you have to use this column now. So the purchases figure is adjusted because I'm seeing those two items. So the purchases amount, right, is 60,800, right, and then you less purchases returns. Purchases returns is what, 1,350, right? That would give us 59,450. And then now we can add our carriage inwards. And our carriage inwards figure, right, is $450. So that would now give us a figure, right? So this is 59,900. And you add that to that now, right? You're going to get 91,530. Right? This figure actually have a name. You can call it the cost of goods available. This is the cost of goods you have available to sell, right? And it is pretty easy to understand if you try and reason it out. If you're starting a business, right, you go start with some stock in the business, not true? So that's an opening stock, right? So that's your opening stock. But the stock we have in our business maybe not enough, so you go buy some more. That is purchases, right? So if you add your purchases to what the stock we have in the business already, then you're going to equal to the amount of goods we have to sell to people. Yeah, so the stock we have plus what you buy, you're going to equal to the amount of goods we have to sell to the people. Simple, right? The only thing is just that these little calculations that you did, the adjustments that you did to purchases, right? But this is the cost of goods available. All right, and then now we are going to subtract our closing stock. So less closing inventory. So our closing inventory, closing stock is always located outside the trial balance, for the most part, outside the trial balance. So pay attention to that. So the closing inventory, right? I know that persons may be wondering, you know, sometimes when CXC put the closing inventory in the trial balance, sometimes they do that, right? But for the most part, the closing inventory would be located outside of the trial balance. All right, so the closing inventory is what? 36,530. 36,530. 30, right? Now this amount would give you your cost of sales, or your cost of goods sold, as some teacher would want to say. Doesn't matter, it's not a big deal, right? So you end up with your cost of sale being 55,000. I could have put my cost of sales in line with this to save space, but I wanted to show you the cost of sales figure. All right, and then now we are going to subtract our cost of sales from our net sales to get our gross profit. And the only reason why I know that it's a gross profit is because the cost of sales is smaller than the gross profit. If the cost of sales was larger than the net sales, then it would be a gross loss, right? You don't normally find that still, but it can happen. All right, so the gross profit here now would be 35,200. Now this is where I normally tell my students to stop and to just look, see what is happening, right? Check the adjustments, because now the adjustments will start coming in. Check the footnote, because now the adjustments will start coming in. All right, so I want you to check the footnote, right? When we reach the gross profit, the rule is that we add revenues to gross profit, right? When we are doing adjustments to final accounts, the rule is that we add revenue to gross profit. Now there are three revenues that they normally ask. So there are three revenues that they can expect to see in case of anything. So the revenues that they can ask, right, most commonly: commissions received, discount received, right, reduction in provision. Provision for bad debt, right? These are the common revenues. Sometimes they will have rent received too, right? That is also a revenue that you would need to add to gross profit if given, right? But I hardly see the rent received one, but I normally see the commission received, discount received, and the reduction in provision for bad debt, right? And all of these information, you would have found them in the footnote. So you have to check the footnote. So by checking the footnote, I realize that I see discounts received, right? Discount received is there in the footnote, right? They did talk about provision for bad debt. It says that provision for bad debt to be increased. Now, when provision for bad debt is increased, it's not a revenue, it's an expense to the business, right? Provision for bad debt is basically you are making a provision. You think that a debtor will not be able to repay his debt. So instead of you being shocked with the bad debt, you are making a provision that, all right, you know, maybe the youth can't go pay me back, you know, so I'm going to make a provision, or I'm going to just say, you know what, maybe you know pay me, so I'm going to make a provision for it right there. So I'm going to make an allowance for it right there. That is what the provision for bad debt is. So the debtor can actually pay, right? So things can work out and the debtor pay, right? That would be a reduction, right, in provision, and that would be a revenue. But say for example, you have more debtors now who hard time reach, right? And you think, say, boy, you know, they are just not going to be able to pay. Let me make an allowance. That's an increase in provision for bad debt, and then that would be an expense. All right. So footnote D say that provision for doubtful debt to be increased to 880. That is an expense, right? And you'll see how I treat it in a little while. So let's go now. The discount received, right, of 210 is a revenue. So we're going to add discount received. Discount received of what? 210, right? So our new gross profit, or our adjusted gross profit figure is what? 35,410. All right, good. So now we can move on to the profit and loss section. Less expenses. All right. So now we are going to subtract our expenses, and it is extremely important for you to be looking at the footnotes while you are doing this. I always tell my students that when you are doing adjustments to final accounts, use the footnote when you reach to the expenses part. Use the footnote to guide you to do the expenses, right? So that you don't miss any adjustment. So I'm going to be using my adjustments from the footnote. All right, good. Yeah. So the first one that I can pick out is wages, right? Or insurance rather. It says footnote B, insurance prepaid, $44. Now the rule concerning prepayment, right? Prepayment. What is prepayment? Prepayment is when you are paying in advance for something. So say for example your rent, right, is say $10,000 per month, but you find yourself with some money. So instead of paying for 1 month, you pay for 2 months, you pay $20,000, right? Therefore, $10,000 would be prepaid. So that's prepayment. You're paying in advance. But with the income statement only accounts for the current year. So we are only dealing with 2017. But if you pay for 2018, right, we have to subtract it. Yeah? Right? We have to subtract it because we're only accounting for what happened in 2017. And that is why you subtract prepayment. So the rule is for prepayment, you subtract prepayment, right? And then there's another one called accrual. Accrual is when you are owing, right? You're owing is the opposite. And the rule is that we add accrual, right? What I tell my students to remember it is for accrual, you just need to know one, you know. For accrual, right, you see the A that start accrual, you just say add. So accrual you add. And if you know that for accrual you will add, then you will know that okay, for prepayment you are going to less, because if you know one, then you basically know the other one. All right, so for accrual you add, for prepayment you less. So we have insurance prepaid. Insurance. Now some teachers will teach you can put down here less prepayment in another line, but for space constraint and it's you can just do the calculation here and put the final figure here. It doesn't matter, right? You won't lose any mark for it. So prepayment, the insurance figure is 204 minus the 44, and that would give us a figure of, let me see, 160, right? And you put your expenses in the middle column, right? The next adjustment, because remember I tell you that I'm using my footnotes to guide how I write in the expenses section. So C, wages outstanding, 506. That is what we call accrual. They can say outstanding, they can say owing, is the same thing as accrual, right? So wages owing or outstanding or accrued is 506, right? Remember the rule as it relates to accrual, we add. So wages, right? So the wages is 5,310. Look, that you can find that in the trial balance, plus the accrual, which is 506. Right? So your final figure is 5,816. Right, good. The next item in my footnote that I want to use because I don't want to forget is footnote D, provision for doubtful debt. It says provision for doubtful debt to be increased to 880. Now, if you look in the trial balance, you will see it says that provision for doubtful debt is what? For at the start of the year is 805. Provision for doubtful debt at the start of the year is 805. But now the question is saying that it has increased to 880. It means that it has gotten more, right? So it was 805 first, right? It was 805 first. Let me just take this out. It was 805 first, but it has increased to 880, right? How much did it increase by? Well, if you say 75, then you are correct, right? So 75 is the increase, and the 75 is what you are going to record. It is important for you to remember that principle. It is the 75, it is how much it increased by, right? So you're going to put now provision, or you can put increase in provision. Put that. Increase in provision for bad debt, and that is what? $75. All right, $75. And then we move on to footnote E, right? And it says that we should provide depreciation for the year, and they're really kind to us in this question, right? They just give us the figure. They could tell you that the depreciation can be done in the reducing balance method, and so forth. They could, you know, make it more difficult. So depreciation there, let us write in the depreciation, right? So depreciation for fixtures, is what? 2,200. And depreciation for motor van is 1,620. Right? So now that I have used all my items in my footnote, I can now go back to the trial balance and just put in the other expenses that I see. Right? So I'm going to go back to my trial balance. Okay, so I see motor expenses, carriage outwards, discount allowed. So motor expenses, carriage outwards. What else do I see now? Discount allowed and rents. Discount allowed. Oh my gosh, do I have enough space? Rent and rates, and bad debt. Bad debt is an expense, you know. So let me put in my motor expenses now. Motor expenses, 1,864. 864. Carriage outwards, 310. Discount allowed, 309. Rent, and this is rent paid, by the way. It's rent and rates though. 810. Then you have bad debt. The bad debt is 1,516. Right, so you're going to add up these figures to get your total expenses. Total expenses would be what? 14,680. And then you subtract total expenses from your gross profit to get your net profit, which is 20,730. 20,730. Right, you would double line that. I'm running out of board space, and I know that probably you guys can't see what I'm doing right now, but I'm going to show you net profit. All right. So basically, this is the second part of what I just did. All right. So you have motor expenses, carriage outwards. So these are all the other expenses I put there, and then I total it, get the 14,680, subtract it from the gross profit here to get my net profit there, right? And that is how you do the income statement, right? The adjustment to your income statement. All right, good. So let's move on now. Going to do the statement of financial position. All right, so I'm going to take this off. And I know people may be asking if this recording is going to be available afterwards. Yes, it is going to be available afterwards. All right, so you can just pay attention to that. Look forward to that. All right. So we're going to do the statement of financial position now for J. Webster. All right, you can write balance sheet or you can write statement of financial position, whichever way. But the new name is statement of financial position. (31st of December 2017). All right. So let's do the statement of financial position. Now, the concepts relating to the statement of financial position. All right. The statement of financial position basically shows the accounting equation. So it shows your assets, liabilities, and your capital. Right. That's all it shows, and that's the basic thing as it relates to the statement of financial position. It has 4 headings generally, but it can have 5 headings, up to 5 headings, right? And we're going to look at the headings, right, in this question. All right. So let's get right into it. So we start with our first heading, which is fixed assets. As you go higher, they may say non-current assets. Instead of saying fixed assets, they will say non-current assets. The same thing. So don't be thrown by the name, right? So our fixed assets, we have 2 fixed assets there, right? And you have to remember, you know, that when we are doing adjustments to final accounts, you can see that I have 3 columns here, right? If you are not doing adjustments to final accounts, or you're just doing a regular balance sheet, right, you would not need 3 columns, right? But the 3 columns are specifically for if you have adjustments to be made, right, or if you have more than one current liability, right, then you would need the 3 column, right? So I look in the question and I see I have 2 fixed assets or 2 non-current assets, right? Fixtures and motor van. Remember, when you're listing your non-current assets, you should list them in the order of what? Permanence, right? So motor vans, right? So the fixtures at cost, right? And this part is very important. Fixtures at cost is 11,000. It said it in the trial balance, right? So you put it there. Fixtures at cost. The motor van at cost, it said it again in the trial balance, 9,400, right? So it's there. You get what I'm saying? Now, the depreciation figure is very important, and this is where it can become tricky, because when you are doing adjustments to final accounts, you have to use, in this section, you have to add the accumulated depreciation plus the current depreciation for this year, right? What do I mean? So if you're, for example, for the fixtures, right? For the fixtures, the accumulated depreciation, right, is shown in the trial balance. So if you look in the trial balance, you will see it says provision for depreciation. Fixtures, it is what? 440. So let me work out fixtures, show you. So it is 4,400 rather, right? Then in the footnote, right, it says that depreciation is to be provided 2,200. 2,200. So when you add this, when you add this, right, the total value for depreciation for fixtures that you're going to record in the balance sheet is what? 6,600, right? 6,600. So this is the accumulated depreciation, and this here is the current depreciation. I normally just tell my students to footnote depreciation. So that is how I get the 6,600. All right. The same will be utilized for the motor vehicle, right? So motor vehicle will be 3,980. And then now you will subtract your depreciation from the cost to get the net book value. Net book value, right? So when you subtract it, you get 4,400. And then for the motor van, you would get 5,420. All right, so you add them up, right? This would be, the cost column would add up to be 20,400. The depreciation column would be add up to be 10,580. The net book value column would add up to be 9,820. Right? We are going to double line these, the cost and the depreciation column, to signify that we are not going to be using these figures again, because we're not going to be using them again. Right? We're only going to be working with this figure, and that is the reason why it is not underlined. So we move on now to our current asset section. Current assets should be listed in the order of liquidity, right? Which means you're listing them from the least liquid, right, to the most liquid. So you start from closing stock all the way down to cash. So we start with closing inventory, and I'm using the new terms, closing inventory. If you write closing stock, not a problem, right? It depending on what you want to do, your preference. Right, unless it is asked of you in, on the question paper to use the new terms, then you can use the old terms for those persons who are used to the old terms. All right, so the closing inventory is what? 36,530. 36,530. Right, and then now we move to debtors. That is how it normally is. Now, when we are doing adjustments for final accounts, right, the debtors figure, or you can say accounts receivable, right, many times needs to be adjusted, especially if you have provision for depreciation. And the provision for depreciation that you will use is the one that is shown in the footnote. So debtors, the debtors figure, all right, let me use a new term, accounts receivable, because that is what you're going to be seeing a lot these days. So accounts receivable, right, accounts receivable, and because I know that it is to be adjusted because I see the provision for doubtful debt, right, I'm going to put it in the first column. So it's 22,460, right, and then I'm going to less provision for bad debt or doubtful debt. I'm going to just put bad debt, right? So provision for bad debt, they said that it has increased to what? 880, right? So it is 880 you're going to put here. You're not going to use the 75. The 75, you use it in the profit and loss section of the income statement, but you are not going to use it here, because the balance sheet is a totals account, you know, you deal with total. So provision for bad debt. So you subtract it and you get what? 21,580. Right. Good. Now you have to now stop and check, right? Because a current asset, right, included in the current asset section, you should have prepaid expenses, or accrued revenue, right? You rarely see the accrued revenue, right? It's like rent received, but you rarely see it. But if you see it, you know it's supposed to come here too. But prepayment should be here as well. So the prepayment, right, that you made is going to come here because it's prepaid expense. You made one prepayment, right? And the prepayment that you made was for what? $44. $44, right? You made a prepayment on insurance for $44. So you're going to put it here as well, right? Then you have your bank account, your banking information. What is the banking figure? The banking figure here is what? 5,850, and then you have cash. So you see we are moving from least liquid to most liquid. Cash would be the most liquid, 150. So you add up that to get your total current assets, right? You get what? 64,150. 154, sorry, 64,154, right? And then now you less current liabilities. So your current liabilities are basically like your accounts payable, or creditors as they would call it, your short-term loans, or if you're owing on your expenses, or you call it accrued expenses. These are all current liabilities. So let's look at it now. So we have accounts payable, right? Accounts payable, or you can say creditors. So accounts payable, right? We have 11,960, and then we have accrual, right? We had owed some money. We had some money outstanding, right? It's what, $506? Yes, right. Do we have any other current liability? Have any loan, any short-term loan, right? If you have a long-term loan, it would not come here. Long-term loan would go into another heading that's called long-term liability. So you would have another heading that says less long-term liability. I'll show you how you will do that. All right. So your current liabilities add up to what? 12,466. 12,466. Right. And you're going to subtract your current liabilities from your current assets, right, to get what is called your working capital. So how you get working capital, guys? Current assets minus current liabilities. That's how you get working capital, right? So your working capital would be 51,688. They have a name for it, you know. They have another name for working capital. They could say net current assets, right? So your working capital, you would now add it to this figure, your net fixed assets, to get the first double line figure, right? 61,508. This also have a name, but people don't normally use this name, right? This also have a name, but people just don't normally use it. I think it's called total net fixed assets, something like that, right? But we're not going to use that name. Then now we move to the next. Oh, let me show you. If you have a long-term liability, because they made us give you one in the exam, you know. So a long-term liability would be a long-term loan. Long-term loan would be like mortgage, right? That's a long-term loan. So if you have long-term loan, you would have another heading now that says less long-term liability. Boom. I will put the loan there. Or let me just use the term what they might give in the exam. They might say mortgage. Zin, right? So the mortgage would come here. You would subtract it from that. You would get this figure, and then this figure would be the double line figure, right? And then you would move on now to finance by. So if you have a long-term liability like mortgage, then that is how you would do it right there. Please pay attention to that, right? You can snap a screenshot or whatever, right? But that is how you would treat a long-term liability. All right. So let me take this out. All right. So we move on to the next heading. Right. When you reach right here, so you basically finish. It's easy from here on in. So you move to finance by. This section really shows how your business is financed, right? The business is financed by capital. So you're going to write capital, right? That is what we call, and this capital is what we call the opening capital now, right? This figure is actually what they call closing capital too, right? This is closing capital, and then this one would be opening capital. So the business was financed by capital. The capital figure, you'll find it in the trial balance, 47,933. 47,933, right? Then now you would add your net profit, the same net profit that we got from the income statement. You would add it here now, and our net profit figure was what? 20,730, right? So that would give us a figure of what? 68,663. And then now you less your drawings. Remember that I told you that drawings is an expense that we don't really treat, like the other expenses. So drawings is used in the statement of financial position. So it's 7,155, right? And then now you subtract your drawings, and you should get back this figure, 61,508. That is our closing capital figure. And when this figure and this figure is the same, then you know that your balance sheet is correct, right? Or your statement of financial position is correct. So what you need to look out for in the exam, what you need to look out for as it relates to adjusting final accounts, you need to look out for this, right? Look out for this, the depreciation adjustment that you need to make. You need to also look out for this, the adjustment that you have to make to accounts receivable, right? You need to also look out for the prepayment, the prepaid expense, that it should go in current asset, and accrued expense, it should go in the current liability. And you need to also look out if you have a long-term liability, because if you have a long-term liability, right? If you have a long-term liability, let me just let you see down the bottom here. Yeah. If you have a long-term liability, you know that you would have to subtract it from this figure right here. Before the first double line figure, you would subtract it from the first double line figure to get the double line figure, right? Before you go to the finance buy. But yeah, then the peeps, right? There you have it. Let's move on. Another thing now, we're going to move on to partnership accounting. Let's go. All right, so you know what? All right, let me leave the partnership right for now, right? I'm going to be doing question 6 of 2009 paper, the ratio analysis. Seeing that we just finished the income statement and the statement of financial position, right? We can just continue with the ratio analysis. All right, so let's do the ratio analysis. All right, so ratio analysis, right? It is not enough to know how to draw up the income statement and the statement of financial position. You need to be able to analyze and interpret what these information mean using accounting ratios, and then you can analyze these financial statements using the ratios as well. So this is the question that we are going to be doing, 2009 question, right? This paper here, right? For persons who are just joining, right, you can look in the description below and you will see, right, a link, right, that is there that you can, the link will take you to the question papers that I am doing. All right. All right, so let's look at this ratio question. Again, when you see the question, you just read through the question. Don't get flustered. Don't start tear out a hair or, say, boy, I don't know how to do it. Just take a time, look at the question, right, and just read through the question. Take it step by step. See? All right, so it says that Lodenkwi Mart and Budai Mart both trade in ladies and children's clothing. Their financial statements at the 31st of December 2008 show the following. And the reason why I am using these old papers, right, is if they are going to test you on something, they're not going to test you on something so recent. They tend to like to test, like for a 5 to 10 year period, right, in the past, right? So if they're going to test you, they probably pull up back a question similar to this. But the thing about it too is that they are using booklets now. So there is this is back in 2009. You realize that they would provide an extra booklet for you to write in, but now it's just one booklet you're going to be getting, right? So I just found it easier to do it this way, right? Use the older papers where you can see the entire question, right? All right. So let's look at this question now. So they give us the they give us the statement of financial position, and they also gave us some additional information like opening inventories, total sales, purchases, stuff like that, right? And then they say that we are supposed to now calculate, right? They give us 4 ratios that we need to calculate: current ratio, asset test ratio, inventory, our stock turnover ratio, and the profit margin ratio. Now, ladies and gentlemen, right, let's look at some of the concepts of accounting ratio. We have 2 types of ratios when we're talking about accounting ratios. We have the profitability ratio, right? The profitability ratio. Now these are the ratios that shows how profitable the business is. That's profitability ratio. And then we have liquidity ratio. Liquidity ratios. Right? Liquidity ratios simply, tell us how the business would cope if liquidated, or how easily businesses assets are to convert to cash. Basically that, right? So you have profitability ratio. Some examples of profitability ratio are like return on capital employed, net profit percentage, gross profit percentage, right? The examples of liquidity ratio are like acid test ratio, right? Acid test, current ratio, right? Debtor to sales ratio, right? Creditors to purchases ratio. Those are examples of liquidity ratios. All right. So let's get right into it. The important thing or the difficult thing about accounting ratios is learning the formulas, right? The formulas are extremely important, obviously, because if you don't know the formulas, then you know. And unlike the maths exam, they are not going to be giving you the formulas. They are not, right? So you're gonna have to know the formulas, right? I don't know how soon you can know the formulas. Tomorrow is the exam, but you're gonna have to know the formulas, right? So let's go. They ask us for what? So this is question 2 on 2009. Question 6a. Question 6a, right? 1. So they ask us to show to calculate the ratio for both businesses, right? So we have to do for Lodenki and Budai Mart, right? So I find it easier to just put a table here, you know, where I can just do them easier. So I'm gonna just put idea. I'm gonna be having limited space, so yeah. So the first ratio is the current ratio, right? The current ratio. What is the current ratio? So the current ratio is current assets divided by current liabilities. That is the current ratio. I always tell my students to write the formulas, right? Write the formulas so that the examiners can see that you actually know the formula. So even if you're calculating and under exam pressure, you may calculate something incorrectly, you can probably still get a mark for just having the formula. So they will say, oh, well, I know that this person know what they're doing because they have the formula. But if you don't have the formula, then they are going to assume that you don't know anything about it. And so your miscalculation is an indication that you don't know, and they will not give you the mark. So write the formulas, right? You don't have to write the formulas at the side here like what I did. I would normally write it underneath the title, but because of space constraint and I don't want to have to be, you know, all over the place, right? I just put it at the side here, right? So the current ratio, the current assets, right? Current assets. Now, you know, one of the things that I realized about this particular question, right? The way how they structure the question can throw you off big time, right? Look at this. The current asset, you know, the current asset would be 1, 2, 3, 4. These 4 figures right here now. Yeah. So you would want to look at this 143,000 and think that, okay, this is the total current asset, but it's not, right? It is the total assets, both fixed and current. So you have to add up these 4 figures. Yeah. You have to add up the 4 figures. So you add up the 4 figures, right? And you get 112,300. And the current liabilities, right? The current liabilities for Logwendi, right, is 33,000. For Budai, current assets would add up to 134,000. Current liabilities would add up to 108,400. Right? Now, what is the significance? All right, let me just give you the calculation. So you get 3.4 to 1, and this would work out to be 1.2 to 1. What is the significance of this? Right? It's important for you to not only be able to calculate them, but to be able to understand what it means. Right? Now, the current ratio would show, right, how how much time your current assets can cover your current liabilities should the business go bankrupt. So should the business go bankrupt, right? What this is saying, is that for L, Linguindi or whatever the person name, right, Mart, they can cover their liabilities, right, 3.4 times, right? It's not bad, right? It's not bad at all. A good current ratio is 2 to 1, right, or 1.5 to 1, right? Sorry, 2.5 to 1 or 2 to 1. It's a good current ratio, right? This would signify that, they are probably too liquid, right? But it's okay, right? For Budai is 1.2 to 1. It would signify that they are able to cover their, their current liabilities. Yes, they are able to do that, right? But it's running it very close, right? And you're going to see what I mean when I say running it very close when we do the acid test ratio. So let's do the acid test ratio now. So the acid test ratio is also called the quick test ratio, right? And the reason why it is called the quick test ratio is because it's a quicker calculation than the current ratio. Why is it a quicker calculation? Because you're not going to use all of the current assets. You're only going to use some. So for the acid test ratio, the formula is what? Current assets minus closing inventory divided by current liabilities, right? So you're going to take out the closing inventory, right? So then it is 112,300 minus the closing inventory, which is 70,000, divided by the current liability, which is the same 33,000, right? For this guy over here, this person, right, it is 134,000 minus the closing inventory, which is what, 90,000, divided by 108,400. And you work this out now. This would give you 1.3 to 1, and then this would give you 0.4 to 1. Now, a good acid test ratio is 1.5 to 1, right? And an okay one is 1.1 to 1, right? Now, look at this now, right? This company was already did not have a good current ratio because it was below the 2 to 1, right, which is the bottom limit, right? And now, see, if the business would go bankrupt, right, and taking out their closing inventory, they would not be able to cover their liabilities. They would have what I call unlimited liability, right? For the acid test ratio, for the Linguini, right, they have a 1.3 to 1 acid test ratio, and that's not bad, right? That's not bad at all, right? Even though the lower, well, yeah, it's not bad, right? The lower limit is 1 to 1. Let me just write it a little. 3 to 1. I need more space, right? So right off the bat, you can see that this guy, right, their financial standing is not so right. They can't really afford to go bankrupt right now, or else they would be in problem. They would have unlimited liability. All right, so let's move on. All right. So the third thing that they ask us to do is to calculate the inventory or the stock turnover rate. And I want you to realize that this particular, the first part of the question are 10 marks, half of the marks of the question this, all right. All right. So inventory or stock turnover. I can just write stock turn. Sometimes they call it that. Stock turn ratio, right? The formula for that is cost of sales, or you can say cost of goods sold, right, divided by average stock. This is one of the ratio that you have to do additional calculation to actually do this ratio, right? So you would have to calculate what average stock is, and you have to know how to calculate cost of goods sold or cost of sales, right? Now remember, cost of sales, right, would be equal to cost of goods available minus closing inventory. That is how you get cost of sales, right? That is how you get cost of sales, right? Cost of goods available minus your closing inventory, right? And so then average stock is equal to opening inventory plus closing inventory, right, divided by 2. So I normally write it like this: opening stock plus closing stock divided by 2, right? That is how you get average stock. All right, so pay attention to that. Remember, guys, these are some of the topics that are on the examiner, right? Based on what CXE give, right? So you have to learn this. You have to learn this. They did say analysis of preparation of final accounts for sole trader, and also analysis of final accounts for sole trader, right? So you have to learn this because this is going to come on the exam. All right, so yeah, so that is how we're going to calculate our average stock. So then, right, to calculate the cost of goods sold for Linguini, right, is very important. So the cost of goods sold, I want to show you here, right? So cost of goods sold, our opening inventory plus our purchases, right? Opening inventory plus purchases would give us what? Cost of goods available, right? That would be around about 7. I don't remember right now, but it would give us, you know, so 60 plus the 80, right? That would be what, 143,000, something like that, right? And then now you have to subtract your closing stock. So our closing stock up here, closing stock is what? 70,000, right? So you subtract it from the addition of these two, right? So how you get the cost of goods sold? Let me work it out and show you. So the opening inventory for Linguini, it would be 63,000, right, plus the 80,000, right, right? So 143,000, then you minus the 70,000, it will leave us with 73,000. So this is the cost of sales. That is the cost of sales figure, right? This is the opening stock. This is the purchases, right? This is the closing stock, right? Yeah, cool. So that is how we're going to get the 73,000 that I'm going to use. The average stock, right? I'm going to just work out the average stock so you can see how I work it out. So the opening inventory for Linguini is 63,000, right? Plus the closing stock, which is 70,000, right? Divided by 2, right? And then that would give me 66,500. So this is how I work out the figures that you're about to see. I'm going to be using this figure. I'm going to be using this figure. All right. Okay, guys. All right. I'm just leaving you some time to snap if you want to snap. All right. So let me just get into it now. All right. So cost of goods sold for Linguini. I'm just saying Linguini, guys. 73,000. Right, divided by 66,500, which is the average stock, right? And that would give us 1.1, and the answer for stock turn is in times. And the stock turnover ratio, by the way, I should explain it to you. The stock turnover ratio, right, it shows how many times you buy stock or you turn over stock. You get what I'm saying? A profitable company would have a high stock turn ratio. You understand? Because what that would mean is that their sales They are selling. They keep on turning over stock. And they keep on after the manufacturer or the wholesaler go buy stock because they keep on selling and keep on selling and keep on selling. Right? So yeah. So what this is saying is that Linguini turnover stock one time for the period. 1.1 time. I don't even know. You don't have to put the 1.1. Right? So for Budai, let's look for Budai now. For Budai, cost of goods sold is 137,000. I calculated that using the same thing that I just showed you. Same way. 83,500 is average stock. Right? That will give me a stock turn ratio of 1.6 times. So basically, Budai turnover stock 2 times. If you round this off, it will be 2 times. You can run it off or you can let it stay. But what it shows is that Budai is turning over stock faster than Linguini, or what you call it, Lodenki, right? Yeah. Then the next thing, the profit margin. So the net profit margin, right, is net profit. The formula is net profit divided by sales multiplied by 100. This answer is actually in percentage, right? So it's net profit divided by sales multiplied by 100. So the net profit figure, right, is 25,700 for Legwendi or Legwenki, right? The sales figure for Legwenki is 250,000 multiplied by 100. So the answer is 10.3%. Let me bring down my camera so that you guys can actually see what's happening here. Right? Yeah. So for Budai, their net profit was 32,300 divided by their sales, a higher sales figure by the way, 305, right? 305,000 multiplied by 100, right? And the answer to that is what? 10.6%. What the net profit percentage shows, right? It shows for every $100 of sales, how much of it is net profit. So what we are basically saying is for every $100 of sales, 10.3% of the sales figure, all right, is net profit. You're making a net profit from that. It's not bad. Not bad at all, right? But if you look at Budai's business, they are making slightly a greater profit. If we could even round this up and say 11%, right, while this is 10%. So they are making slightly higher profit per sale, and they are having more sales than Ledenki, yeah, right. So you see how I am analyzing as I go along, because this is how they want you guys to analyze it, right? You're comparing both companies, both businesses. You're comparing them, right? Then the other question now, right? The other questions that they ask, it add up to the other 10 marks, right? So I'll just be answering them. Let me come over to this side. I'll just be answering them, right? So part B, it says identify 2 ratios from the list above, right, that can be used to assess the profitability of the business. 2 ratios that I can use to assess the profitability of the business. These 2, stock turn and profit margin, right? Yeah. Then it says identify 2 ratios from the list above, right, that can be used to assess the ability of the business to pay their debt. Obviously these 2, current ratio, acid test ratio, right? D says identify 1 ratio from the list above that best tests the liquidity of the business. So if you're talking about the liquidity, you're talking about how easily your assets are to convert to cash, right? That will best test the liquidity. Current ratio would best test the liquidity because it accounts for all the assets. You get what I'm saying? The acid test ratio don't account for all the assets, you know, right? All the current asset, because what? You don't use the closing inventory. You get what I'm saying? Yeah. Then E, state which business is more profitable using the appropriate ratios to support your argument. If you're going to use a ratio to support your argument, you're going to use the profitability ratios, which is the stock turn and the profit margin. And in both cases, Budai, right, is performing better than Legwendi. So you can say then that Budai would be more profitable based on the stock turn ratio, which shows that they are selling more goods, right? And also their profit margin ratio, which shows that they have a higher profit margin percentage, right? So it's basically 11, right? And this is basically 2 times. And then for Legwendi, it is 1, and this is 10%, right? So Budai is performing better there. So then the last one says, state which business is in a better financial position, and you can use appropriate ratio. Now, I would say that Legwenki is in a better financial position, and the reason for me saying that is because of their current ratio and their asset test ratio. What these 2 ratios show is that should the business go bankrupt, right, how well are they able to cover their liabilities? And you can see that Legwendi, right, is well able to cover their liabilities if the business should go bankrupt, right? And it shows that they have what you call limited liability. But they, on the other hand, cannot cover their liabilities sufficiently based on the asset test ratio, right? And therefore, they would have what you call unlimited liability. So Legwenki is in a better financial position than Budai. However, Budai is more profitable, right, than Legwenki. And that is possible, right? A business can be profitable, but still not in a great financial position. And that is why these accounting ratios become very important. All right, next question. Moving on. Partnership. We're going to be doing partnership now. And there are other ratios that you need to learn, right? Like the return on capital employed ratio, for the profitability ratio, right? That's an important ratio that you need to learn. So check it out. Return on capital employed, right? Return on capital employed, very important ratio that you need to learn, right? The formula for the return on capital employed ratio. I'll put some notes. As a matter of fact, what I'll do, I've already taught this topic. I'll put a link to the description. In the description, right, that will show you the return on capital employed. All right, but you need to learn that ratio, right? They normally ask for that ratio. And you have another one that they call debtor to sales ratio and creditor to purchases, right? They can also ask you for gross profit margin or percentage, they can also ask you for, what's this other one, man? It was just in my head a while ago. Expenses as a percentage of sales, right? They can also ask you for that ratio as well, right? For all these ratios they can ask you for, right? The big one, the most important ratio, right, they will ask for is return on capital employed. They always call it the ROCE, right? So these ratios, I'll just put a link. Just check in the description. You see a link to the formulas for these ratios. Very simple, very easy. All right, so don't worry yourself. All right, boom. But you need to practice, though. You need to practice. All right. So one of the big topics now, partnership accounts. What are the concepts now? right? So for partnership accounting, right, we know that a partnership is an association of 2 to 20 persons who come together to form a business with the view of making a profit. That's what a partnership is, right? In POB or in economics, they will tell you that the partnership business can go up to 20, have up to 20 owners, right? Yeah. The main thing, right? So far, we have been looking at the financial statements for sole traders, right? But if it becomes a partnership, right, they will still prepare financial statements. They will still prepare their income statement. They will still prepare their balance sheet. Yeah, right. The thing about it though is that when they are preparing their financial statements, in addition to their income statement, they have to create another statement to show how the profit is shared up, because the profit is going to be made. Yeah, profit go make, right? But then how the profit going to share up? Should Tom get 50% or Harry get 20% or whatever? The profit must share up. That is where the appropriation account comes in. So the appropriation account, it simply shows how profits are shared. Right? I don't have the best handwriting, but you guys can understand. Right? So the appropriation account shows how profits are shared. That is basically what it is about. Right? Another thing that you need to understand about partnership accounting is this term that they call interest on capital. They say that interest is paid on capital, and the reason why they say that interest is paid on capital is because they are encouraging your owners or your members to invest more money. That is why interest is paid on capital, right? So interest is said to be paid, not charged. So interest paid on capital, not charged. But interest is charged on drawings, right? Interest is charged on drawings, and interest is charged on drawings to discourage the partners from withdrawing too much money out of the business, because that can run the business in bankruptcy, right? I do have a video on partnership accounting, so you can check in the description. I will place that link there. You can check in the description and it will take you to the link for you to understand the theory behind partnership accounting, right? Very simple, very easy. So these are basically the main concepts as it relates to partnership. We do have an account that they call the capital account. And the capital account, it basically shows the investment of each partner. Alright, shows the investment of each partner. Then you have the current account. The capital account, by the way, guys, capital account always remain constant, always remain fixed. As a matter of fact, they do call it the fixed capital account, right? But the current account, as the name states, current, it is kept current. So it constantly changes. So it shows the partner's dealings with the business, right? Everyday dealings with the business. So this account, the current account, will change, right? While the capital account will remain constant, right? Yeah, so these are the basic concepts that you need to know about partnership accounting, right? Because if you know how to do income statement, then you should have no problem here. Let me take this off now. Practice time. Let me take the paper. Partnership is a thing that I can find a lot of questions on. It's it's all over the place, right? Partnership always come. There are a lot of past paper questions on partnership accounting, right? But I choose to do this 2010 one, right? It provides a unique challenge that I want you guys to see. So if you look at it, this is one with Angel and Carissa, right? Yeah. All right. So, as I said before, when you see a question, don't get flustered. Just take your time, read through the question. You'll be fine. So you say that Angel and Carissa are in partnership, sharing profit and losses in the ratio 3:2. Interest on joins is charged at a rate of 5%, right, per annum, and interest on capital is 10% per annum. Angel and Carissa receive salaries of $15,000 and $8,000 respectively. Some of the current account entries for the partners for the period ending the 31st of December 2009 are set out below. So they provide us here with an incomplete current account, right? And then they said we should copy the above in your answer booklet. So I have to copy this in my booklet right now, right? So let's copy this. So it is 2010 question 2A. Right, well it's, yeah. So this is Angel and this is Carissa. Angel and this is Carissa. Right? Put in the dollar signs. Alright. So we have to put in the balances now. Balance BD. For Carissa it is 1700. Right? For Angel, balance brought down. For Angel it's what, $3,000. Alright, we have a drawings figure. Right, 14,000 and 18,000. Then you have interest on capital. Interest on capital 2,500 and 3,500. Yeah. Then we have salary. Salary is 15,000, 8,000. And then you have share profits. I can just put profits, not a big deal. Profits 12,300. And then you have 8,200. Alright. Alright, so now that we have copied what they have there, right? Don't even think they're getting any mark for that, but they asked us to copy it. So the first one that says we should calculate and enter the interest on joins, right? Now let me explain the current account. In the current account, the principle that you need to understand about the current account is anything that increases the partner's capital, right, you will credit. So on the credit side, you have all the things that increases capital. Yeah? Increases the partner's stake in the business. And these are things that decreases capital. So it goes without saying that the current account carries a credit balance. To increase it, you credit. To decrease it, you debit. Joins and interest for joins would be the things that decreases the current account. Interest on capital, salary, profits, all these things will increase the current account. We could even add capital here, you know. But if we add capital here, it would not be called a current account per se. It would be called a fluctuating capital account. Right? But yeah, but the current account. Alright, so they said we should calculate the interest on joins. Now look at it. They said that interest is charged 5% per annum. So 5% of 14,000. 5% of 14,000. Right? Is what? 700. Yeah. So for Angel, interest on joins is 700. For Carissa, it is 5% of what our joins figure is, which is 18,000. Right? So 5% of 18,000 would work out to be $900. Right? All right. Now, for those persons who may not know, right? Even though you should know, because tomorrow is the exam, but if you don't know how to calculate a percentage, when you type the thing in a calculator, it's going to be 5, right, divided by 100 multiplied by whatever the figure is that you want, right, you're using, right? For persons who are more mathematical savvy, right, you can convert it to decimal, so you don't even have to say 5 divided by 100. You could simply say 0.05 multiplied by the number, whatever, you know, that you're trying to find the percentage of, right? But that is what you would type in a calculator. Very important, guys. All right, so that is how I got our interest on joins. So they said that we should calculate and enter the interest on joins, and then they said that we should balance off the account of the partners. So that's easy, right? So we balance off the account, the current account, by, you know, balancing it off just like how we would do a cash book, right? I want to point out though, right, that the current account, it has a credit balance, which means that to increase it we credit, to decrease it we debit. But you realize that it has a opening debit balance, which should not be the case, right? So this is kind of strange right here, right? The 1,700, right? It is kind of strange. And why do we have this balance here? This balance here in Carissa's account, it means that Carissa, right, owes the business money. Because ideally, what it should show, you know, right, for Angel, it means that the business owe Angel what? $3,000. That is how it should be. The business should owe you money. But in Carissa's case, she owed the business 1,700. What could be the cause of that, right? Maybe Carissa withdraw too much money from the business. So drawings could be one thing that will cause you to owe the business money, and that is why they charge interest on joins. So if you look at it, you know, you can look at it and Sister Carissa have way more joins than Angel, and that is the reason why she have a negative balance on her current account. When they are giving you the current account figure, they may give it to you like this. So say for example, they could say for Angel and for Carissa, they could say Angel, right, Angel is 3,000, and they put CR at the end to show you that that's a credit balance. And then for Carissa, it's 1,700, and then they put DR to show that it's a debit balance, right? And they can ask you what this means, and they will ask you what it means, right? That is why you have a debit balance. And just know that it have a debit balance to show that Carissa owed the business money due to her excessive drawings, right? Yeah. All right. So we want to balance off this account now, right? Can balance off this quickly. We don't think we need to take up time balancing off this. So balance, carry down. 18. 18,100, right? And then on this side we have balance carry down for Carissa, 900. Ensure that the totals are in the same column, the same line rather, right? And so you get 32,800. 20,600. Same thing over here. All right, so yeah, so we do this now, right? We already gone 5 marks by just doing this. 5 marks, easy peasy lemon squeezy, right? Then we're doing now 2A3. State the significance of both balances brought down. These two balances. The significance of these, right? So this debit closing balance, right? It signifies that the business owe Angel money, which is good. But this signifies that Carissa owe the business money, as I was just saying. All right. So moving on now to the next one. State one possible reason why Angel and Carissa can earn different salaries, right? Why Angel and Carissa earn different salaries. The one reason why Angel and Carissa will earn different salaries is it can be that Angel, one work in the business while one don't work in the business. That can be a reason, right? Why they earn different salary. Another reason can also be the fact that maybe one person invests more in the business and one person have seniority, right? So they may earn different salaries like that too, right? I don't think I need to write that down. Part B now. 2B. Don't want to take up too much space on the board writing that. Yeah, so 2B now. It's half of the mark. From the information, right, prepare the appropriation of profits account for Angel and Carissa for the year ended the 31st of December 2009, showing clearly the net profit of the business. Now, this, you looking at it, you may think that this is simple, you know. You may think that this is simple. It's a simple, straightforward thing. Right? But it's not as simple as you think. Because what? The net profit has to be calculated. And you may say, oh, net profit easy to calculate because guess what? We see the share of profit here. So, but remember now, the share of profit is not the net profit. The share of profit is the balance of profit. Right? The share of profit would be what is left after you have taken out the salary, you have taken out the interest on capital, you have added interest on drawings to the net profit. So this share profit here does not show the net profit. So let us go. So this is our appropriation account, right? So Angel and Carissa appropriation account for the year ended 31st of 12/09. All right. So the net profit figure. Net profit, we don't know, right? Add interest on drawings for Angel, for Carissa. Interest on drawings for Angel is 700, and because we're adding, we can just put it over here. Carissa, right, is 900, right? Now we don't know what this figure is because we don't know what the net profit figure is. Then we're going to less salary. Who gets salary now? Both of them get salary. So Angel's salary and then Carissa's salary. Angel's salary is 15,000. Carissa's salary is 8,000. Right? But we're also going to less interest on capital. So we're keeping the less. We're keeping this less up here. Interest on capital. Right? Angel, Carissa. So interest on capital for Angel is 2,500. And for Carissa, it is 3,500. All right. So we can add up all of these things now. Add up all of them, we get what? 29,000. 29,000. Right? But you know, ideally we are supposed to subtract this from this to get this figure. We don't know what that figure is. So we still don't know what we're doing yet. And then this would be the balance of profits. Balance of profits. Right, but we don't know what that is. So the share of profit. So this is where we would share up the balance of profits. So share of profits. Right? So the share of profits, we know that Angel, the question, right, we didn't have to work it out. The question give us how to work it out, 3 to 2, right? So let me work it out, show you guys, just in case. But we don't have to work it out. Let me just put down my hand a little bit. All right. So the question told us the profit sharing ratio. It states that Angel and Carissa share profit and losses in the ratio 3:2. Right? How do we work out that? They said 3:2. 3:2. This is what they gave us. 3:2. How do we work out that? Right? So you had it. So 3 plus 2 equal 5. Therefore, one is getting 3/5 and the other is getting what? 2/5. That is how you work it out. You convert it into a fraction. You can even convert this now into a decimal, right? For those persons who are mathematically savvy like that. So Angel is getting 3/5, right? And Carissa is getting 2/5 of whatever the balance of profit is, right? But we don't know the balance of profit right now. Well, what we can do, we can add these, right? See the share profit there? We can add both of them together. When we add both of them together, right, we get 20,500. So they're getting 20,500 of 20,500, right? So when you work it out, Angel is getting 12,300. Carissa is getting 8,200. And the thing about the appropriation account is when you share up the profit, then it's supposed to add up back to what this figure is, which is the 20,500. So now we can reverse engineer, right? So we know what the balance of profit is, 20,500. 20,500, right? Okay, so if we know what the 20,500, if we know this figure, right, we can calculate this figure, because we know that when we take away this figure from this figure, we get this figure. So what is this figure? We have to add this figure to this figure now, right? So it's going to be what? 49,500. So do you see how we are reverse engineering? We're working upwards. So then we know that when you add these two figures to this figure, we get this figure, right? So if we want to find out what this figure is, all we need to do is to subtract these two figures, which is going to be 1,600. Subtract 1,600 from the 49,500, right? Which would give us what? 47,900. 47,900. And so we show our net profit. Boom. And it is just like that. Easy peasy, lemon squeezy. By the way, this is the format, a perfect format for the appropriation account. If you are going to be tested on partnership in the exam come tomorrow, they are going to test you on the appropriation account and they are going to test you on the current account. So these are two important things. There is another question that I have that I saw that was very interesting. I wanted to do, but I did it, right? I did it, but I will post that question so you can see my response, my answer to that question in the footnote, in the description. So you can look there in the description. I don't remember what year it is, but I will post it and I will label it additional partnership question so that you can see how I work out that particular question. All right. But yeah, that's it for partnership, right? Remember to always practice, do your thing, right? And for tomorrow, right, just relax, right? Relax. I may come back later, right, with a lesson on company accounts. It's no guarantee. I can't tell you that I'm guaranteeing that, right? But company accounts is the other thing that I wanted to do, but time will not permit me, right? I have so many things to do, right? But I'll come back. I may come back later on tonight just to run through company account, right? If I don't come back physically like this, right, then I may just do a little video. I may just do a little question and then just upload it just to see him so that you guys can see. All right. So remember, be calm in the exam. Be calm. Don't pressure yourself. Take it easy. Read each question carefully. All right. Good luck tomorrow. God bless. I'm out.